Some of our investors are feeling that familiar market emotion, the urge to do something dramatic with their investment portfolio when they're nervous. And it's the natural human reaction, right? When we start feeling uncertain about things, we want to take action. We want to do something. It just seems like the right thing to do. One retired client emailed me last week with a question that basically translated to, should I move everything into gold, treasuries, dividend stocks, oil companies, and maybe a beach house? In other words, should we rearrange our entire portfolio because the world feels a little wobbly? It's an understandable question. There's plenty happening that can make us nervous. The ongoing military action in Iran, along with the potential consequences around the world, are influencing expectations about oil supply, pushing energy prices up. Gasoline jumped about 9% last week, and increasing defense spending, cybersecurity, insurance, and shipping costs. All of these headlines start stacking up, right? And it's natural to wonder if your portfolio should start wearing a helmet. But history suggests that panic selling everything is not very often not the right move. Over the last 70 years, there have been more than 25 wars and military conflicts. During those events, the S&P 500 typically dropped about 5% on average, bottomed out after roughly 19 days, and then fully recovered within about 6 weeks, according to research from LPL Financial. Even more interesting, about 70% of the time, the market was higher 1 year after the start of armed conflict, delivering average returns of more than 11%, according to Hartford funds. In other words, markets tend to react and then get back to the business of making money. Investors who handled these periods best usually aren't scrambling to make big changes. They've already built diversified portfolios with some hedges and enough cash on hand to avoid the classic investing mistake, panic selling at exactly the wrong time. And while we're talking about mistakes, let's add a tax reminder here. Selling a bunch of investments during a panic doesn't just lock in losses, it can also trigger capital gains taxes on anything you sell at a profit. Nothing adds insult to injury quite like writing a check to the IRS because you panic during a news cycle. Other clients are asking, will the Iran war cause more economic pain than average? The real economic impact depends largely on how long this conflict lasts. Analysts aren't just asking whether the Strait of Hormuz closes, they're looking at how long energy supplies and shipping routes might be disrupted. In the best case scenario, diplomacy cools things down quickly. Oil prices might spike temporarily, perhaps hitting around $120 per barrel before settling back toward the mid $70 range. The worst case scenario looks very different. Global energy markets could face serious disruption. In that situation, oil prices could surge above $150 per barrel. Natural gas prices could jump dramatically, and shipping routes might shift around the Cape of Good Hope, raising global freight costs by 50 to 75%. Energy analyst Mark McNally has described a prolonged closure of the Strait of Hormuz as a guaranteed global recession, quote unquote. The reason energy matters so much is simple. When oil prices spike sharply and stay high, it can trigger inflation and slow economic growth, slow spending, slow business spending. It is similar to what we saw during the 1973 Arab oil embargo, when the S&P 500 fell 37% over 12 months, while high energy prices fueled stagflation. Because roughly 20% of the world's oil flows through the Strait of Hormuz, energy markets are the main way Middle East tensions affect investors. Now, we don't think that's going to happen. That's not our base case scenario here in this situation, but it is worth mentioning. The natural follow-up question to this is, which industries could win and lose? The markets overall are wobbly right now. Certain industries tend to benefit during global turbulence, but the general market has not been as volatile as certain industries have, for sure. Energy companies are often early winners when oil prices rise. Oil giants like Occidental Petroleum, ExxonMobil, and Chevron have historically surged during periods of elevated Strait of Hormuz risk. Defense and aerospace companies tend to rally when global tensions rise. Other sectors may benefit in more subtle ways. Cybersecurity firms often see demand increase as governments and companies defend against digital attacks. Shipping and logistics companies sometimes benefit from higher freight rates. Insurance companies may see premiums jump, particularly for maritime war risk. coverage. Of course, if your portfolio leans heavily into one of these sectors, you might see larger swings than the overall market in either direction. But then finally, probably the most important question here is, what should investors actually do? For most investors, the advice we would offer is surprisingly boring and surprisingly effective. To borrow a phrase from the late President George H.W. Bush, stay the course. That would be for many of our investors, that would be our admonition here. Long-term investing rewards patience more than heroics. Consider this: $100,000 invested in the S&P 500 in 1988 and left alone would have grown to about 4.9 million by 2024. But missing just the 10 best trading days during that period would have cut those results roughly in half. Unfortunately, human psychology often pushes investors toward the wrong decision at exactly the wrong time. Behavioral economists call this loss aversion. We feel the pain of losses roughly twice as strongly as the pleasure of gains. That's why scary headlines can tempt people to sell first and ask questions later. Herd behavior makes things even worse. Research suggests that just 5% of informed investors can influence the behavior of the remaining 95%, creating waves of panic selling. A better strategy is to build a diversified portfolio across industries and geographic regions. Global diversification helps because geopolitical crises rarely affect every country the same way. And diversification across asset classes, including stocks, bonds, and other investments, helps manage risk without constantly reshuffling your holdings. And again, let's not forget the tax angle. The more you trade emotionally, the more you potentially rack up capital gains taxes, short-term tax, capital gains taxes, as well as long, and sometimes transaction costs. Sometimes the smartest move isn't trading. It's simply not giving the IRS a bigger cut of your portfolio than necessary. In other words, the most sophisticated investment strategy during a scary news cycle might look surprisingly simple. Stay diversified, stay disciplined, and try not to let headlines do your tax planning for you. If you have questions, or if you'd like a no cost or obligation second opinion on your investment strategy, give us a call. We're always happy to help. I'm Matt Hearn with Cannon Wealth Management, and thanks for watching.